Hello students, welcoming you all to this economics class. This is Miss Pijano and you are going to learn the chapter 3 today, that is money and credit. So in this chapter you will be learning the topic here, meaning of money, functions of money, barter system, drawbacks of barter system, credit, loan activities of bank, formal sector credit and informal sector credit, and lastly self-help groups. So all this topic I'm going to present you through PowerPoint presentation. So let us all go to our presentation without much ado. Dear students, welcoming you all to this virtual explanation class. I hope you will be able to learn some concepts from this chapter 3, money and credit. So these are some of the topics that you will be learning from this chapter. So let us first learn the first topic from this chapter, meaning of money. So how will you define money, or what is money? So anything which is used as a medium of exchange is called money. You know that the use of the money spent is very large in our everyday life. When you look around you, you will easily be able to identify several transactions which involve money in a single day. For instance, goods are being bought and sold with the use of the money. In some of the transactions, services are being exchanged with the money. For some, there might not be any actual transfer of money taking place right now, but promises to pay the money later. So all these activities, all these transactions involves a medium of exchange. So that is the reason why anything which is used as a medium of exchange is called money. The second topic that you will be learning here is the functions of money. So there are three functions here. The first function of money is medium of exchange. So medium of exchange, it implies a system which facilitates sale, purchase or trade of goods or commodities between two parties or between one individual to another individual. So any transaction or any system which involves sale, purchase or trade of goods between two individuals is regarded as a medium of exchange. So this is the first function that money do. The second function here is the store of value. So store of value, it implies that money can be saved, money can be retrieved and exchanged at later times. So this saving or this storing of value can be in the form of deposit with the banks, and these deposits can be retrieved or collect at later times through in the form of the interest. So this is the second function that money do. The third function here that you will be seeing here is standard of deferred payment. So when I talk about a deferred payment, it means those payments which are made in the future. So deferred payment implies an agreement unit of measures which enables people to contract for future payment and receipts. In standard of deferred payment, there might not be any actual transfer of money taking place at present, but the promises to pay the money in the future. So this is the third function that a money do. So I hope you have all you are clear with the meaning of money and the functions of money. The third topic that you are going to learn from this chapter is the barter system. So barter system, it is a system in which goods are exchanged for another goods. Here in barter system, two people or two individuals agree to buy and sell each other commodities. So this barter system, it has been using by our forefathers or by our ancestors in place of the money. Here, during this barter system, money is not used, unlike today where a currency is being used for exchange of goods. Our forefathers, our ancestors has been using this system in place of the money. However, there were some limitation exists in this system. The first limitation here is the lack of double coincidence of ones. So let us first learn what is double coincidence of ones. So double coincidence of wants, it is a situation where the both parties have to agree to sell and buy each other commodities. It simply means what a person desires to sell is exactly what other wishes to buy. For example, when a shoe manufacturer wanted to sell his shoe and he is in need of the wheat, he has to search someone else who is willing to sell a wheat and who is also willing to buy his shoes. So in that way, both of these individual wants should coincide with one another. However, sometimes it is very difficult to find someone else uh, can who can coincide with one wants with another one. So uh, there was some problem exists in the double coincidence of one. So that is the first limitation. The second limitation here is the difficulty of storing value. So when I talk about difficulty of storing value, it means goods cannot be stored for a longer period of time. So unlike today, where our money can be deposited in the bank or through by buying of an asset, building, land, uh, storing of value through in the form of goods or commodity is difficult during the barter system. So that is the second limitation. The third limitation here is deferred payment are difficult. It simply means future payment is also difficult to meet. And the last limitation here is some goods are indivisible. It means some goods cannot be divided. So these are some of the limitations of barter system uh, that you'll be seeing here. So I hope you are clear with the meaning of barter system and the limitation of barter system. Topic that you will be learning is the modern forms of money. So you have seen that money is something that can act as a medium of exchange in transaction. So before the introduction of the coins, a variety of object was used as a money. For example, during the early ages, Indians used grains and cattle as money. Thereafter came the use of metallic coins, such as gold, silver, copper coins. So all these um, forms of money has been used continuously for a longer period of time, for at least a century. But however, as time goes by, a new modern forms of money exist. The first modern forms of money here is currency. So currency includes a paper notes and coins. This currency is accepted as a medium of exchange because it is authorized by the government of the country. As in India, the Reserve Bank of India issues the currency notes on behalf of all the central government. So as per the Indian law, no other individual or no other organization is allowed to issue the currency except RBI, that is Reserve Bank of India. Hence our rupee is widely accepted as a medium of exchange. So this is the Reserve Bank of India located in Mumbai. And for your general knowledge, the present RBI governor, the Reserve Bank of India governor is Shaktikananda Das. The second modern forms of money here is deposits with bank. So the other form of money in which people can hold is deposits with the bank. At some point of time, people need only some currency for their day-to-day needs. For instance, workers who receive their salaries at the end of each month have an extra cash at the beginning of the month. So what do people do with the extra cash that they have? Uh, in simple terms, they deposit this extra cash with the banks, but by opening a bank account in their name. Here, bank accept this deposit and also base an amount and interest on this deposit. In this way, people's money is saved with the bank and it also earned an amount with interest. Also, people have a provision to withdraw this money as and when they require. Since deposits in the bank account can be withdrawn on demand at any time or anywhere, these deposits are called demand deposits. The third forms of money here you'll be seeing here is the checks. So check is a paper instructing a bank to pay a specific amount from one person account to another person account in whose name the check has been made. In this way, money is transferred from one bank account to another bank account, and transaction is complete without any payment of cash. Check is also the safest mode of transferring money because it avoids any possibility of theft. So this is the third forms of money that you'll be seeing here. So I hope you are clear with these three forms of modern forms of money: currency, deposits with the bank, and checks. The next topic that you are going to learn is the meaning of credit. Now, what is credit? How will you define credit here? Credit is the other name of loan. It is a contractual agreement in which a lender supplies the borrowers with money, goods or services in return for the promise of future payment, generally with interest. When we are learning this credit topic, I want you all to take to the story of bank further, and we are going to learn some of the loan activities of banks. Have you ever wondered what do the bank do with the deposit which they accept from the public? There is an interesting mechanism worked here. Bank keeps only a small portion of their deposits as cash with themselves. For example, bank in India these days holds only about 15% of their deposit as cash. This is kept as provision to pay the depositor who might come to withdraw the money from the bank on any given day. Since on any particular day only some of its many depositors come to withdraw cash, the bank is able to manage with this cash. So in this way they uses major portion of the deposit to extend loan. Bank make use of the deposits to meet the loan requirement of the people. They also mediates between those who have surplus funds, that is the depositors, and those who are in need of this fund, that is the borrowers. Banks also charge a very high rate of interest on loans than what they offer on deposit. The difference between what is charged from the borrowers and what is paid to the depositor is the bank's main source of income. In this slide, you will learn the terms of credit. Every loan agreement specifies an interest rate which the borrower must pay to the lenders along with the repayment of the principal. In addition, lenders may demand a collateral, that is a security against the loan. So all these interest rate, collateral and documentation requirement and the mode of repayment together comprise what is called the terms of credit. Let us learn what is collateral here. Collateral is an asset that the borrowers own. These assets can be in the form of land, building, vehicle, livestock, deposit with bank, and they uses this as a guarantee to the lenders until the loan is repaid. In this way, if the borrowers fail to repay the loan, the lender has the right to sell the assets or collateral to obtain the payment. The next thing that you are going to learn here is the formal sector and informal sector credit. So loans credit can be taken from the two sources, that is a formal sector credit and informal sector credit. So now what is called the formal sector credit? Formal sector credit are those loans which we get from the banks and other cooperative institutions. Here in formal sector credit, the Reserve Bank of India supervises the functioning of the formal source of loan. Here, the rate of interest is also reasonably low, and they usually ask a collateral when they give a credit. However, in informal sector credit are those those loans which we taken from the money lenders, the traders, the employers, the relatives and friends. There is no such organization which supervises the credit activities of the informal sector. That is why lenders charge any rate of interest to the borrowers, and there is no one to stop them from using any unfair means to get their money back. So here is this slide shows the difference between the formal source of credit and informal source of credit. Last topic that you are going to learn from this chapter is self-help groups. We also call SSGs for the board. In the previous sections, you have seen that the poor households are still dependent on informal source of credit. The reason here is banks are not present everywhere in rural India. Also, even when they are present, getting a loan from the bank is much more difficult than taking a loan from informal source. Absence of collateral is one of the major reasons which prevents the poor from getting the bank loan. That is the reason why in recent years, people have tried out some new way of providing loans to the poor. The idea is to organize a rural poor, uh, in particular the women's group into a small self-help groups. A typical self-help group has 15 to 20 members, usually belonging to one neighborhood, who meet and save regularly. Saving per member varies from rupees 25 to rupees 100 or more, depending on the ability of the people. Members can take small loans from the group itself to meet their needs. The group also charge interest on these loans, but this is less than what the money lenders charge. After a year or two, if the group is regular in saving, it becomes eligible for availing loans from the bank. In this way, loan is sanctioned in the name of the group and is meant to create a self-employment opportunities. For instances, small loans are provided to the members for releasing a mortgaged land, for meeting working capital needs like buying seeds, fertilizer, raw materials, bamboos, and clothes. For us housing, for other housing matters like acquiring assets like sewing machine, handloom, cattle. So in this way, today's self-help group has become one of the building blocks of organization of the rural poor. It does not only help a woman to become financially self-reliant, but the regular meeting of the group provide a platform to discuss and act on variety of social issues such as health, nutrition, domestic violence, and other social issues. So these are some of the topics you have learned from this chapter. I hope you are clear with all of the discussion that you have seen from the first slide itself. You will be learning the next chapter, the next topic in the next video explanation class. Okay students, so that's all about this unit, this chapter. I hope you have learned something about this chapter, that is money and credit, through the slide presentation which I have shown you just now. So we'll be learning the next topic in the next video. Until then, stay safe and stay healthy. Thank you.